Hey, what's going on, everybody? I wanted to make a quick video over that's going to cover on how to hedge and when to hedge your portfolio. Because thinking about it, like right now, there's going to be so many people that tomorrow, after this big red candle today, are going to be talking about, oh, I need a hedge, I need a hedge. But in reality, you should have hedged earlier, and the signals were kind of there. And I just want to point them out and talk about it. Um, and show you how I personally do it, and actually show you a trade that we did to hedge our positions in the small account mentorship. All right, so first things first, how and when. Well, first let's talk about when. When do we put on a hedge? So for me personally, I have a few things that I watch for in terms of a hedge. First off, are we rallying or are we pushing into resistance? So here's a SPY. I want to zoom all the way out, and you see these lines I have drawn up here. And these price levels that I have drawn up here are from these recent peaks. So we have this one right here, and you can see how this was resistance here, and then there was this little resistance here. Well, that being said, we're hard to believe we're right at these peaks again. Well, we are extended into these pretty key levels of resistance, in my opinion. So how do I define extended into resistance, right? What's my definition of extension? And the easiest way to do it is the Keltner channels. I'm going to go ahead and zoom in on, or just magnify this chart here. So I have right here, I have the +1, +2, and +1, +2, +3 ATRs away from the daily 21 EMA. So if I zoom in here, you can see we opened up here at the third ATR right here at these resistance levels. All right, so that's basically like the first check mark, right? From a technical perspective, we are extended, and now's a good time to put on some hedges. And the reason I wait for into resistance, because you can't deny up here, we're hitting the third ATR band for a while. And I personally like to wait for a technical pattern as well, as far as like hitting into resistance, to signal it, to put on a hedge. Sorry, I had a hard time getting that out of my mouth. There's one other thing too, and it's the put call ratio. And you see I have it down here, and I have it fully explained right here. So you could put the $P call in your charts anywhere, and just you could write this text out there and make these little price lines. And this is my little guide that I always have up here. And I do wait for more confirmation. I don't exactly just chase it into the put call ratio. Like if we're outside, like right here, if we're below the 0.8, look for a pullback or sell off. Like we've been below it for a while. If you look as I move my mouse around down here in the put call, you can see the line moving up here on the SPY chart. And you can see we've been up below, or sorry, yeah, below it for a while now. And so that's why I also wait for a little bit more of a technical pattern to go ahead and follow it as well. But if you're, once we get below it down here, and you could also just go really far out of the money, like Delta 30, like 90 days to expiration puts as well, and probably be just fine. But all that being said, not only are we extended out to the third ATR, that's something to acknowledge for putting on a hedge into resistance. And like I mentioned, the put call ratio, it is below 0.8, which signals the market is really long and basically look for a pullback or sell off. I want to show you this. I'm not sure if y'all have seen this before, but what I want to do first off, let's see. I want to put my mouse down here where it is below 0.8, and I want you to notice how it marks right here. I'll get my pen to draw it out. So right here, we're below 0.8, and that lines up with right here. Oh, it's not going to show it because of the drawing tool. Here we go. But you see the line, right? Watch the line. I'll put it down below 0.8, and it's up at the peak. Now I want to go up to where it gets above 1. Look for a bottom and short covering. Right here, up here, above 1, it went to 106, and that's when it was right here. You see, and then we moseyed on down. Didn't quite get there, right? Okay, cool. Didn't quite get all the way to 0.8, and then we go all the way back to above 1. We got to 113, which is right here. The market couldn't go any lower. All right, cool. So then we rallied, and we go back to 0.8. You see how we rallied to here. And then I want to go ahead and go back up to this peak where we got to basically 1.1. And from there, that's where this low is. And then we kind of hovered in between for a while as price oscillated here. And now here we are way below, or we were way below, down to 0.6. And now we're moseying back towards 0.8. All right, so that's basically, we'll call it three things you could look for, really. So you have the put call ratio here, like I mentioned, right? And you could, like I said, you go ahead and mark these out on your charts if you wish to follow these. And then also, besides that, the trigger is outside of the third ATR into resistance. So those are basically your signals. You should at least be putting on some hedges because you can't deny the market's been pretty long, but eventually a pullback's going to have to happen, at least down to the reversion to the mean, which is basically on the SPY down at, we'll call it 448, just rounding it up to the whole dollar. So how can you play this? There's several ways you could play it. So when the put call ratio gets below those key parameters, I did learn this from John Carter many, many years ago, was, you can go out to buy delta 60 to delta 90 puts that are at a delta 30. So that's one way you can play it. Me personally, in a short-term perspective, and as I waited more for a technical pattern, I expected it to play out a little bit faster than 60 to 90 days. You could do I'll just put a P for a put calendar spread, and I'll explain why a put calendar, which is what we did in a small account mentorship, and allow me to explain why. All right, so first, we did this live in there, and we'll go ahead and bring this on over here. I'll let you see the alert. So you see right here, we did it right at 12:22 p.m. Right before the flush happened. Luckily, I mean, it doesn't always happen that way, and I didn't know when the big move down was going to happen. I expected maybe a small range candle today, and then tomorrow we'll get a follow through. I didn't know we'll have a big bearish engulfing candle today. Hence why I did the put calendar out to August 4th. If I would have known even quicker, I would have structured it a little bit differently. But nonetheless, you buy a longer duration put, and then you sell a shorter duration, same strike price put for a net debit. And at that net debit, it allows you to take advantage of downwards move, and actually is very cheap. You see it on the SPY, it was 42 cents, so a max loss of only $42. And for a small account, that's pretty helpful. If you have a large account, you could do an SPX, and that would just been 420 bucks. So there's a couple of different ways to do it. So why a put calendar? I want to pull up the analyze graph. All right, so here's what it looks like right now. Right, and for a quick down and dirty way to read a risk graph, if you don't know, down here is the strike price. Here is your P&L, as in your profit and loss on the position. This is your profit and loss on the position at expiration. This purplish line is your profit and loss on the current day. So you can see where your profit and loss is on the current day at the current strike price, basically, right here. But you can see for expiration to be up here. Also, there's one other little key thing, is this little box right here. I could move my mouse around and tell you where your P&L would be for the current date and expiration. All right, so why a put calendar versus puts and all the things like that? So, or a vertical. It all, for me, it all had to do with the Vega. So I could have done the out of the money puts, could have done that. But to be honest, I didn't know when the mark was going to sell off or pull back. And it was reversion to the mean. I'm not going to call it a sell off because it's not. It's just reversion to the mean. I didn't know when it was going to happen. And honestly, I was looking to have my cost average cheaper because this is for small accounts. So that's why I didn't do the puts. If I would have done a vertical, it doesn't matter if it would have been a put debit or a call credit spread. Nonetheless, for the most part, Vega, depending on how wide you make the strikes, is pretty much canceled out. You have no implied volatility. Benefit is strictly directional, and you have there's not a much Vega increase. If volatility increases, you have no benefit from the Vega increasing. All right, so now what about a put calendar? And you could absolutely do both variations, but this is just how I did it in a small account because, like I said, it's only 42 cents. All right, so the put calendar, I'll just put cal. All right, put calendar. So think about it, as price goes down, Vega, that's hard. Drawing with the mouse is pretty hard. Also known as implied volatility, increases. This is a Vega positive position. So as price goes down and the volatility increases, we still get the benefit of the price being increased versus if it was just a vertical, the volatility is going to increase, but you're only getting the directional move. You don't have the volatility in your favor. Now you could have done long puts and volatility absolutely would have been in your favor, but it is a the variable was when is it going to move lower, and this is just a better low risk way to hedge your positions. All right, so yeah, like so there's that. And one cool thing about it is I want to crunch this for one position, like I said, risking $42, right? If it pulls down, right, and I sold the 450s because that is down near the mean, right? The mean is a daily 21 EMA. So typically, if you think about it, what typically happens is price comes down and it'll probably potentially oscillate in this zone, right? Before potentially moving back up or even, who knows, maybe even further dip, who knows. But nonetheless, we kind of oscillate here before making the next move. Well, as price dips in between down to about 440, let's say it does come down to test the support at 444, but we don't completely skyrocket either. Then if you think about it, and it oscillates at these key levels, just heading into August 4th, you see max profit is $182 with a max loss of $42. So that's a very good risk reward. So ideally, as price sells off and just heading into August 4th, the SPY just oscillates in the middle near the mean, and then at the as time passes, your P&L goes higher and higher from the theta decay. So you get a kind of a double whammy there. So that is just several different ways you can hedge your positions or your portfolios. And the only reason I'm making this video is because I imagine a lot of people in the rooms that we have and stuff, they're going to be like, oh, a lot of the members are going to be, oh, we need to put in hedges and stuff. Like the hedges should have been talked about today versus tomorrow. And so I just wanted to talk about that. And but yeah, that's typically when I do it based off of extensions. I'll set a 30 TR into resistance, or if the put call ratio is below 0.8, and it's all written in my trading plan, all in the trading plan that I actually talk about in this. We just had a webinar last night as well, me, Allison Ostrander, and John Carter, and how I basically traded 3 strategies over and over again to grow a small account. And if you're interested, just come check out the webinar. It's at simplertrading.com/secrets for hyphen replay. If you're interested in just watching the webinar to see how it works, but this hedging criteria is all in my trading plan. So just wanted to point that out to y'all. I wanted to show you when you should be putting on a hedge, how you can put on a hedge. Like I said, it's either long puts, the days to expiration is the variable for you there, and when you're putting it on, a put calendar takes advantage of the IV expansion and the theta and the delta move, and then but verticals, if that's something you want to do as well, I couldn't blame you for it, but it just hedges out the volatility versus taking advantage of it. But that is all I have for y'all. If you have any questions, please feel free to ask a question in the comment section of this video. I like to answer all the questions, make sure everyone's on the same page. And then, yeah, other than that, hope everyone has a wonderful rest of your week, and I'll catch you all in the rooms tomorrow. Take care, everybody.